Hello, welcome back. This is the second in a series of three master classes regarding private equity real estate as it investing. And I am Alan Blair. I'm the CEO and founder of the REI Capital Group of companies. I've started in commercial real estate in 1985. And back then, there were no computers. There was no anything. We had over 100 tenants, 100 units in apartment buildings in the Bronx. It was our family business. And we had everything on index cards and controlled rent. Everything was manual. We did have Texas instrument calculators, and that was about it, and fax machines. So I learned real estate from the ground up, real basic. Next screen. This is the obligatory disclaimer. I'm not a financial advisor. This is not financial advice. This presentation is for educational purposes only. However, I am a commercial real estate broker licensed in the state of Connecticut. And as such, I can give advice on investing in commercial real estate. And I'm qualified and expert at it. Next slide. So I chose to run these three series based upon Tony Robbins' brand new book, The Holy Grail of Investing, because he's making a lot of noise with this book. He's talking about it all over the world. And we're about to launch two public designer private equity funds focused on real estate. So I needed to know, what he was saying in this book. I wanted to know who he was talking to, and I wanted to know how he said it, because I'm intimately familiar with how difficult it is to convey complex ideas in a simple fashion to people, to investors. And Tony's the best at it. So I'm still learning from Tony. Next. So, what is the Holy Grail? All the wisdom that Tony is articulating in this book depends upon the reader being able to find two things, an investment that offers two things, and that is uncorrelated investments and compounded returns. Talks about it throughout the entire book. So before I play this next clip, I want everybody to think in their mind, try to, what do you think an uncorrelated investment is? And then we're going to play the clip, and then we're going to talk about, play the clip.
I'm sitting down with Ray Dalio, one of the greatest investors in history. One of the questions I asked him then was, what's the single most important investment principle, if you knew nothing else, that would make you successful? And here's what he said. I finally figured out that the biggest challenge is loss and risk. Everybody wants upside, but to get more upside, take more risk. It's not right for everybody. He said, but I've discovered if you have 8 to 12 uncorrelated investments, you'll reduce your risk by 80% and increase your upside. Here's what's unbelievable, Tony. He goes, if you have 8 to 12 that are uncorrelated investments, he said, you can sleep so nicely at night and still have great returns. Well, it's hard because so many things are correlated today. Yeah. And if you go to the average person, they're investing in stocks and bonds and maybe real estate investment trusts, REITs, but they often get very correlated. And then nothing works. But there is another asset class that most people know nothing about, private real estate. And if you go to the Fortune 400 and say, what most billionaires in the world, what industry? Tech? Nope. Real estate? Nope. Financial services yet, but it's not hedge funds that go up and down. It's these guys of private equity. They're the kings of the financial world. It's mind-boggling.
Okay, so we didn't play the part where he describes what Ray Dalio advised him was uncorrelated. And he said typically it has to do with, bonds versus equities. And now they used to be opposite to each other. And he kind of used that as example. And then he said, well, that didn't work anymore. Everything was correlated. And it is. Everything is correlated. But the question for you is, did you think in terms of stocks and bonds or ever think that way? Or did you think the way I did, that uncorrelated means have nothing to do with the stock market? If it goes up, it goes down, it doesn't matter because we're totally disconnected from the stock market and the public markets. That's what I thought it meant. So I didn't understand that at the beginning. But then we dig deeper. Next slide. So that image is what AI thinks uncorrelated alternative investments should look like, which is totally a mishmash as far as I'm concerned. So now you see why in the first class I talked so much about words and how it's used in financial services, because uncorrelated means different things to different people. I looked it up in Google, and apparently all these quants are out there and they're doing all kinds of historical analysis on various stocks and bonds and this and that, when this stock goes up, that kind of goes down, and they can, in the computer, they can switch it and try to, it's like jumping off an elevator when it's going down to the bound, try not to, hit the floor. So I found it totally useless. So a couple things to distinguish between what's correlated in private equity versus private real estate. The distinction is this. Private equity is when a sponsor, a general partner, sells securities by raising money and then invests it in other securities. And another security is buying a company, because you're buying shares, partnership shares, you're buying stock, you're buying whatever it is, whether it be on the public markets or not. So that's private equity. I'll give you an example. Austin Dental. Is it Austin Dental? That's owned by a private equity firm, and they're growing it and developing it, and they're probably going to, make it public someday to get their money out. Private real estate's a little different because you sell securities, you raise capital, and then you invest it directly in real estate, directly into hard assets. And that gives you a certain advantage because there are less rules that you have to comply with the SEC and FINRA and everything else. So when the sponsor is in private real estate, they, 100% of the time, they try to have to comply with the least amount of rules as possible. So understanding the words of what uncorrelated means is important, because otherwise you don't know what they're talking about. The one thing that he did say, not sure if we played it, but one of the benefits of private equity, which includes both equity and real estate, is they have the benefit of time. One of the reasons why that makes it uncorrelated to the markets, directly uncorrelated, is because it's not traded on Wall Street. So if they don't sell, if the market's down, if everything's down, if they don't sell, there's no consequence. And they can wait until the market's right, and then they can take the benefit of an upside. So that's kind of what he means by uncorrelated, private equity being uncorrelated. And to a certain extent, that's true. However, there's indirect correlation with debt. So just like with real estate, we've seen it. The Fed raises interest rates. All commercial real estate leverages debt, and that drags real estate values down. But you don't have to sell unless you're on Wall Street, because on Wall Street, you've got all these other rules mark-to-market rules, and you have mark-to-market rules is a killer. Mark-to-market, because if the last person who buys on a down tick, that's the value of your whole company till the next day, and meanwhile everybody else is following, and all you get is volatility, and we don't want that. So I wanted concrete proof that the funds that I was designing would be totally uncorrelated. So I happen to have a neighbor who is a quantitative risk analyst on Wall Street, super quant, and he does this for the biggest firms, and he's been successful his entire career. So we spent a lot of time trying to figure out how he would do the math, how he would figure out whether or not private real estate, the way I designed it, would be correlated or not, and to what degree. So the way we designed this study was we went to CoStar and we downloaded all the statistics having to do with cap rate for all commercial real estate since they started accumulating the data. So we had data from 2000 to 2022, 22 years of quarterly cap rate price adjustments for all types of real estate. And you'll see here all that little skinny line across to the left. Those are the various types of real estate that was all segregated in the data. The third, fourth, and fifth one, the smallest ones, that's the kind of real estate that I focus on. This is retail real estate, 3 different kinds. And so then he, on his own, wanted to compare that same period, same quarterly results of price changes for REITs, which is that tall chart, and the S&P 500 index, the SPX. So this is called a relative risk ratio. It is a statistic used for measuring risk-taking behavior, investing, into one group of investments and comparing that to the findings resulting from an identical risk-taking behavior in another group, public REITs and SPX. It's night and day. So this is what uncorrelated looks like. It's proof positive. So understand what a cap rate is. Cap rate is a measure of price in real estate. It is the net operating income. So you collect your rents, you pay your bills, it's what's left over, divided by the price. You get a cap rate. So what this measured was a change in price from one quarter to the next. So that way everything was apples to apples. And he did the same thing with the other indexes. So it's completely uncorrelated to public market. Next slide. So it does exist. This is what it looks like when you crunch all those numbers down and you put a percentage of risk on it. The blue on the left, it's nearly flat. The red is the SPX, your risk level compared to each other. And the green is public traded REITs. There's no comparison. And here's the great part. The uncorrelated nature of the real estate is with 99% statistical confidence. That is unheard of on Wall Street and is unachievable in these other two things. Nothing is that level of confidence. So commercial real estate, in my opinion, is the only asset class that can be structured to provide true uncorrelated rate of return with uncorrelated to volatility of the public markets. And this is how more wealth has been created in the United States of America than all the other asset classes together. Commercial real estate. And I'm going to give you one more story. So, as I'm talking to a lot of people over the last several years, I talked to this one manager, real estate fund manager, who works for a very large family office. Family office is a family that's got a lot of money, so much money that they have to hire people to manage the money. And they want to be involved in commercial real estate. So what this fund would do is they would buy Class A, coffee table quality commercial real estate, fully leased and everything. They'd pay top dollar for it, and they'd own it. And it's paying rent, but they don't need the income. So what do? They reinvest the income, and they buy more top quality commercial real estate, and they grow the value of the portfolio, and they grow their wealth year over year over year over year, and they get large. And that is compounding growth. Next slide. It is. Einstein called compounding growth the eighth wonder of the world. And I ask everybody listening to this video, watching me now, can you think of a single compounding growth investment that's available to you today? And I've asked many people this question, and nobody could actually think of one. Sometimes somebody might say a REIT. But a REIT is not a compounding growth. Even if, you check the box and they say, would you like me to reinvest your dividends, every month? No, that is not compounding growth, because even though they're reinvesting the dividends, you still get the 30% tax bill on the money that they were otherwise distributing to you, because that's a distribution of profits. And very often in these private, non-traded REITs, and we see it online a lot, they all have redemption programs. They say, yeah, we have a redemption program. It's always with a discount from whatever the price is. And very often they don't have the money to offer the dividends, the distributions, or the redemptions, because as a REIT, they have to give away or distribute 90% of their profits every year in order to qualify as a REIT. So that is not a compounding growth product. I would like to read to you a simple example of what compounding truly is. And so if I were to offer you a choice between an immediate cash payment today of $1 million or a magic penny that doubled every day for 30 days, which one would you take? Well, like most people, you're going to jump at the $1 million, right? But if you break out a calculator and you start doing the math, you're doubling that penny for 30 days. You'd be amazed to find out at the end of 30 days, it'd be worth over $5 million. That's magic. So we're going to play this clip now.
People don't understand. They have all heard of compounding.
Right.
The richest people in the world don't do it by getting rich. You get wealthy by taking a little bit of money over time and compounding it. So I tell parents, teach your kid who's 19, put $300 a month away. Put in the stock market, average returns 8% over time, 8 to 10. Don't let them touch it. And if they started at 19 and you just do it to 27 years old, $300 a month. The total amount's like 28 grand over those 8 years. Never invest again. They're set. Compounding, just like the million versus the 139 million, 26 for 139, it's both getting in the game and it's where you put it.
So, if you listen to that carefully, you would have heard that he suggests put it in the stock market. The average rate of return over a long period of time is 8 to 10%. It's compounding, right? Come on, this is a total cop-out. Whoever gets the average rate of return, that totally disregards all of the ups and downs. We haven't played it yet, but we will shortly. The first rule of investing, wisdom from Warren Buffett. The first rule of investing is don't lose money. The second rule of investing is go look at the first rule. And that's the reason why. And he explains it. Think about it. So if you have $100,000 and the market goes down 50%, you now have $50,000. In order to get back up to where you were, it's got to go up 100% in order to get back up to $100,000. So the average in the stock market, that dog don't hunt. I think it's a cop-out. Okay, next slide. This is what compounding looks like in a mechanical way. It's smooth. It goes up, and it builds interest on interest on interest on interest. This is what it looks like. So I like to tell the story about my wife's retirement account. We have an advisor, and my wife is extremely risk averse. So we put it in, we put a bunch in the money market. We earn nothing. And then we put the rest in a very conservative growth annuity. Guaranteed. You can't lose money. It's going to go up. Okay. Fast forward, it must be about 10, 12 years. And we're going to have a call with him. And I lay out all the December 31st balances in a row, last 8 years. And I go back and I'm looking, oh, okay. And then 2 years, it went down. And went down again. And then now we're back where we were 3 years ago. We got him on the phone. We said, what's up? He said, yeah, well, you said we couldn't lose money. I said, you didn't? What do you mean? He says, well, this is the principle you put in, and it can't go below that. Well, that was 10 years ago. Words mean things, and it's not always the same thing that you're hearing is what they're saying. So, nobody ever gets the actual average return over a period of time. Even when you hear these CEOs of REITs talking about their returns, they cherry pick the lowest point in the index of when the dates and the highest point when they exit in order to do their numbers. It's all engineered. Next slide. So, this is where I get into the first rule of money. Don't lose money. So, the word is starting to leak out that these elites, the top 1% that Tony's talking about, are accumulating cash. Currently, they're not even rushing towards private equity. There was a recent article in CoStar News that highlighted that the private equity industry as a whole is having a difficult time raising capital. This is the worst capital raise in 11 years. Today, on PitchBook, I received a report just today. Real estate's rocky road through 2023. Closed-end private real estate funds raised $98 billion in 23 when the data was finalized. This may still be the lowest fundraising figure since 2012, as lenders pull back, issuing debt for new projects and high interest rate dampening deal making. Opportunistic and distressed strategies stack up the most commitments as asset managers and lenders offload office portfolios at steep discounts. So it makes you wonder, maybe these elite 1% know something that the rest of us don't. 2 more articles I read. The most sophisticated smart money learned the last time the market crashed, and they are preparing to get ahead of the imminent, all-encompassing, massive drawdown that they anticipate is on the horizon. They focus all of their expertise and resources to become beneficiaries of everyone else's losses. Everyone else, they're talking about you. Next one. To understand the designer nature of private equity, Consider that accredited investors represent 10% of the U.S. population. Qualified investors, 5 million and above, represent 1.5% of the U.S. population. The proverbial 1%, those who have $100 million liquid cash, they operate in a completely different world. Those are Tony Robbins' friends. And they operate in a completely different world where risk is pushed down to everyone else and sold as unavoidable. Sound familiar? So I ask you, is the public markets rigged to fail for the public? Play the clip. The point was, the market's turbulent. It's bad for everybody else. Good for us. And they know how to manipulate money, because in the markets with mark-to-market rules and all this stuff, when you control investments with a lot of zeros, you actually push the market where you want it to go. And that's how you manipulate it. And with that, that ends Masterclass number 2. Thank you.